Hello, I'm Robert and welcome to my channel where I talk about everything automated algorithmic trading or simply algo trading. Today is going to be a fun video and one that it has been requested now for a while. When dealing with Forex or crypto or any leveraged market, figuring out your leverage rates and your margin rates are critical. For Forex, which is what I'm going to cover today, the broker makes this extremely easy. And I'm going to go through and talk about that in this video. How to get your math right so you mitigate liquidation as much as possible. Now, there's no guarantee that the market's just not going to go completely hell-bent haywire. But this can really reduce the risk of liquidation if you follow these steps carefully. First, let's go to Oanda's margin rates page. And you will get a list of all of the active margin rates right now. Make sure you set your leverage specific to your account. My leverage is 50 to 1. Now find the pair that you trade. For the purposes of this demonstration, I'm going to use EURUSD. But all of these pairs can be traded. So let's try to find EURUSD. And it's hiding in here somewhere. Okay, where are we at? I know the leverage rate is 50 to 1, so it's not that big of a deal. But it helps if you find it. Okay, here's Euro Canada, Euro Franc, EURUSD, finally. Right here, 50 to 1. Now what makes this so nice is we can use a very simple mathematical equation. 1 over 50. That will give us a decimal point that becomes our margin rate when we multiply out our math. And that is exactly what I've done here. I've set up a very simple spreadsheet that will help me figure out my minimum budget based upon what I am trading. So let's start with a raw budget of $1,000. That's it. That's my bottom line, $1,000. That's for the entire account. So I only want to use 37% of my account. I anticipate I want to trade 2 pairs. So you can't go above that 100% of your account balance. I could do 50-50, but I want to give a little extra room just in case. Now my point with these mathematics is to be overly defensive. And that is the critical part that will help you mitigate your risk as much as possible. So I'm going to be leaving roughly 13% padding just for this one pair. So that gives me a usable working budget for EURUSD of $370. Now realistically, I don't want to use all of that. I really want to try to stay below half if possible, just for a little extra padding. So what I've done is I've tried different numbers and I've come up with something that works well. But I will show you some numbers that you want. For example, your starting units. Let's start with 20 units. And you will see that your worst case margin unit or worst case margin usage is going to be $32. How do we get that? Well, I'm using 20 levels of stop loss. So no matter what, my grid will never be more than 20 levels. The space between each grid is going to be 1 unit. So my lowest level is going to be 20 units, then 21 units, then 22 units, then 23 units, all the way up to my highest level of 40 units. Each level is 1 level higher than the previous in order to qualify for my jurisdiction's FIFO regulations. So my unit depth is going to be 40. So 40 times 20, and well, you see the equation here. D6 is the 40, D11 is my worst case price. Let's talk about that. If you go back throughout the history of EURUSD, you see that the highest price it reached was $1.65. I rounded that up. So my worst case price that I want to base this on is going to be $2. So let's look at the equation again. D6, ending units, 40 units at $2 each is going to give me $80 that I'm going to be spending. Now we move to D8, which is my stop loss level. $80, 20 levels, $160, and now finally the margin rate, the 50-to-1 ratio, 0.02. So I end up with a final margin worst case usage of $32 with these settings. And that leaves us with a safety barrier of $64 because I have multiplied my worst case margin usage by 2. Now, why did I make this multiplication? Well, because Oanda has a policy that you can go into a margin call if you go above 50%. So in order to try to stay below the 50% margin limit that Oanda opposes, I double the number. So if I have a budget of $64, even though my worst case usage is only going to be $32, then I should never need to worry about a margin call, let alone a margin closeout. And if you get a margin closeout, it closes out the entire account, not just that single asset. So it's incredibly, critically important that you spend the time really working over these numbers carefully. And it is better to be defensive than to over leverage yourself in such a way that a worst case scenario can wreck you. It's very devastating to lose your whole account on one asset going wrong. So always plan for more while you need less to help mitigate the risks as much as possible. Now, this isn't going to bring in very much. You're only going to be bringing in 1 to 2 pennies per trade. It's not, basically it's a penny scalper. But we have $1,000 budget and we have usable $370. We're only using $64 worst case. So we now can play with our numbers to get close to 370 safely. So let's see what we can come up with and go through the math slowly and carefully. So we know 20 units, so let's go to 50 units. Well, that puts us at 112 as our worst case scenario. Let's try 100 units. That puts us at 192. Let's try 150. That puts us at 272. Now, do I really want to go above that? Probably not. You probably want to stay below 1/2 of this value as a more extreme defensive case. So, how about 125? Well, first of all, let's find out what 1/2 of 370 is. That's easy enough to do. $185. So let's stay below 185 as an additional safety boundary. Okay. Let's keep going. Let's see if we can really dial this in. So if we start with 95 units and we end with 115 units, our actual budget usage is going to be $184. Even though that's been doubled and our real worst case scenario margin usage is only $92. This gives you a very good defensiveness to really be able to manage your risks. Worst case scenario on a defensive level. Now you can tune these even more, and you don't have to limit yourself the way I'm doing it. But running a grid bot is, of its own situation, a risk when you have stop losses. You want to mitigate that risk as much as possible. So by doing this, you're actually only allowing really 1/4 of the risk versus 50% that Oanda allows. So let's look at this again. Starting budget, the maximum margin limit usage you want for this single asset. That provides you with the amount in budget that is physically usable for this one single asset. In this case, EURUSD. If you want to be defensive, take 1/2 of it. And then figure out your starting units. The ending units will automatically be multiplied in by your unit steps. For example, what if you want 20, 25, 30, 35, and you want your ending units to go that way? Well, your start of 20, your step of 5. You now have a maximum 120 units for your highest level of your grid. You have a worst case margin usage of $96, and if you double it and you run your risks, you will need a minimum of $192 for this asset to safely be able to trade it without having to reasonably worry about your margin limits or receiving a margin call. And of course, you can play with this and dial it in even more. Now, you cannot have partial units. So if you choose this approach, you are going to get some gapping between your usable amount versus the actual required amount calculated. But for the purposes of what I am wanting, a simple approach, let's just go very basic, very simple. Starting units 95. I have 20 levels. Critically important here with the Oanda grid bot that I built. 20 levels. This is not your price, but level count. And the stop loss is only available through the sponsored version. And you can find out that information on the relay page. By sponsoring it, you'll get access to the private repository that gives you the full-blown everything version. So 20 levels, and with each level is one step. So we have cascading in the units of 115. That's our worst case scenario. So 115 units multiplied by your levels multiplied by your units. And there you go. And then you take that and you multiply it by your margin rate. Very simple mathematics. Very easy mathematics. But having this tool is really critical to making sure you can do well with your trading. Now for my second pair. The second pair I trade is USD franc, and that has a margin rate of 0.04. So as you can see, this is not going to work. So I need to adjust these numbers so that I can deal with the additional margin rate with respect to my budget. And it's just trial and error, dialing these numbers in until you get as close to, but not over. That technically is over. You could probably get away with it, but for the sake of safety, let's just stay under. So 37 starting, 57 ending, one step, 20 levels. My worst case margin is going to be $91. My minimum budget for that asset of USD franc needs to be $182.40, just to make sure that I am well within my margin limits and I stay safe. That is critical. Now let's see what happens when you scale this down a lot and really cut it close. Let's take a budget of $130. Now for the purposes of this budget, here's what I'm doing. I'm going to strictly go with this value. $48, my usable margin, $32. I should have 64, but I'm just going to go with strictly this. $48 required to trade this budget. Remember, these are recommendations, not absolutes. I have my stop loss and I've done my calculations and I am well within my safety margin limit. In fact, I'm only using 5% according to Oanda, using this technique. So it is important that you understand that you don't need to keep this written in stone. There is flexibility as long as you stay under this value here. This is the most critical component. So in this case, I am well under that, enough that I feel confident in trading with this budget. Now let's see what happens if I trade a pair like dollar franc. Well, my worst case budget is over my minimum. I'm in trouble. This means I'm over leveraged. I have to, at the very minimum, match my worst case level for safety. That's critical to understand. Very critical. Always make sure that your worst case margin is below your usable budget level as a safety layer. Double check your numbers, make sure, and always be prepared to deal with this kind of situation. As I said in the beginning, this is not a guarantee that you won't be liquidated or you won't get a margin call if something really goes wrong. But this step does do well in trying to mitigate your risks as much as possible within a reasonable level of confidence that you can calculate on a worst case basis. Now, for the particular point of the USD franc, the price never has gone above, I believe it's $1.2. And even then, it's been a long time ago. So adjust that, and you see the worst case margin changes as well. So always check your chart, find the highest value, and double it. And that will give you a good worst case approach, a good balance, and this is close. So check your numbers, check your charts, check your prices. Take the steps necessary to always protect your profits and your initial budget. This will compound on its own over time, and the stop loss adds an additional layer to keep you protected. It's not foolproof, but so far in my testing and in my own live running, this technique has done well to protect my account. Never underestimate the market. And always think worst case. You could just use the high that you've ever encountered, which is fine, but I wanted that additional padding just as an additional safety layer. Even if you are being aggressive in your settings, always think defensive in your budget. Thank you for watching. Leave a comment below and let me know how you manage your margin. Whether or not you've taken these kinds of steps to really figure out if your account is safe. Let me know what techniques you use to protect your balance. Give this video a like so other people can find it and learn easy techniques for protecting their balance and from preventing margin calls. And if you're not subscribed, please subscribe. Thank you for watching, and until next time.